They warned you it was finished. They insisted Friday marked the peak. They told you to cash out, take the win, and step aside. But Monday morning delivered its own verdict, and it didn't come quietly. It arrived as a single green candle that erased the entire bearish narrative in less than 1 hour. Look at the screen. Silver is trading at $69.14. Earlier in the session, it touched $69.40. That's nearly a $2 surge from the open, almost 3% in one trading day, on a Monday morning, without a war, without a crisis headline. That is not normal behavior. Commodities do not move like this unless something underneath the market has snapped. What you're witnessing is not optimism. It's not speculation. It's not a trade. It's a liquidation. The institutions that leaned short into Friday are now trapped. They are underwater, exposed, and running out of time. And right now, they are doing the only thing left that keeps them alive. They are panic buying, not strategically, not patiently, but urgently. They are slamming the buy button, trying to cover positions before price reaches $70, because they understand exactly what sits beyond that level. $70 is not just resistance, it's the line of no return. If that level breaks, control shifts to the algorithms, and price enters a vacuum. And that vacuum doesn't pause at 71 or 72. It accelerates straight toward 75. Today's move was the warning shot. To understand how violent this rally truly is, you have to rewind to Sunday night when Asian markets open. There was no hesitation, no dip, no probing lower, just an immediate gap higher. And then something even more telling happened. Price didn't retrace. It didn't test support. It didn't look back. It opened high and kept climbing. In technical terms, this is known as a gap and go, and it signals urgency. It means buyers were not willing to wait for a pullback. They weren't negotiating over cents. They wanted exposure immediately. And that raises an important question. Who buys like that? Retail investors wait for dips. Funds use limit orders. The only entity that buys with this kind of aggression is a forced buyer, someone facing a margin call, someone whose broker just issued an ultimatum. Close it now, or we close it for you. That confirms what many suspected over the weekend. The margin calls were real. Banks spent 48 hours assessing the damage from Friday, and this morning they pulled the plug. What we are watching is a forced liquidation event unfolding in real time, and the fuel driving this move is the bank's own money. Now let's talk about the high of the day, $69.40. Why did price hesitate there? Why didn't it rip straight through $70? Because round numbers matter. Traders call them big figures. Psychologically, humans are programmed to react to them. As price approached the upper 69s, short-term traders locked in profits. That's normal behavior. But here's the critical detail. Price didn't collapse. It didn't snap back to $67. It barely pulled back at all. Instead, it hovered just below the ceiling. In technical analysis, this is known as pressure, repeated pressure. Think of a locked gate being hit again and again. The first impact weakens it. The second cracks it. We just saw the first strike at $69.40. The fact that price remains elevated tells you sellers are being absorbed. Every contract sold is immediately taken by a buyer. Eventually, the sellers run out. And when no one is left offering at $69.99, price doesn't crawl through $70. It jumps. Now visualize what's happening on trading desks in New York right now. You're managing the short book at a major bullion bank. Millions of ounces sold on paper. On Friday, you believed $65 would cap the price. Now it's Monday. Silver is trading near $69. Your losses are flashing across the screen. Risk alarms are going off. Your risk manager's standing behind you. Can you add more shorts? No. Limits are maxed, so you cover. But every time you buy, price moves higher. Your buying triggers panic at the desk across the street. They buy too. That buying forces the next institution to follow. This is the feedback loop that destroys shorts. This rally isn't driven by greed. It's driven by fear. Fear of losing control. Fear of balance sheet damage. Fear of being the last one left holding the bag. Now look at the media. Is silver dominating the headlines? Of course not. They're talking about equities, rates, earnings, because a surging silver price is an admission of failure. It signals inflation, currency stress, and loss of confidence. That silence is deliberate, and it's bullish. It tells you this move is still being driven by institutions and desperation, not the public. The crowd isn't here yet. Grandma isn't calling. Your Uber driver isn't asking questions. When the headlines finally break, that's when the next wave arrives. And if silver is already at $69 without the public, imagine what happens when they show up. The trend is clear. The banks are covering. The $70 wall is cracking. But there's one more variable that turns the situation from dangerous to explosive. The calendar. Late December, holiday week, senior traders leave, volume dries up, liquidity thins. In normal markets, that means boredom. In a squeeze, it means chaos. And that's where this story goes next. Now we get to the most dangerous ingredient in this entire setup. The thing most people ignore because it sounds boring, but it decides whether a move becomes a grind or turns into a vertical spike. The calendar. It is late December, holiday week, 3 days before Christmas. In the financial world, this is usually when the lights dim. Trading floors empty out. Senior traders disappear. Big funds stop pressing risk. Market makers tighten up. Volume thins. Most years, that means the market goes quiet. But when you are in a squeeze, low volume does not mean peace. It means fragility. Because liquidity is not the same thing as price. Liquidity is the ability to buy or sell without forcing the market to move. When liquidity is deep, you can place a big order and the market absorbs it. When liquidity is thin, even a moderate order can shove price like a shoulder into a weak door. Here is the simplest way to visualize it. Imagine a swimming pool. If you jump into a pool, the water level barely changes. That is what a liquid market looks like. Tons of buyers and sellers, a thick order book, plenty of depth on both sides. Now imagine a bathtub. Step in, and water spills over instantly. That is a thin market. Same action, completely different result. Most of the year, silver trades like a pool. Not perfectly, but deep enough that the big players can hide their footprints. During holiday week, the swimmers leave. The pool becomes a bathtub. The order book starts to look hollow. Instead of hundreds of contracts stacked at each price level, you might have a few dozen. Instead of real two-way flow, you get gaps. Empty air. So what happens when a whale comes in and buys 500 contracts? In a normal market, price might tick up slowly. In a holiday market, the buyer chews through the offers in seconds. They hit the first layer at $69.50, then the next at $69.60, then $69.70, and before anyone can blink, you are printing new highs. This is slippage. And right now, slippage is the bull's weapon. Here is the part that makes it even worse for the banks. Normally, they act as shock absorbers. When buying gets aggressive, they lean against it, provide liquidity, and keep price from exploding. They have the balance sheet to do it, and they have the authority to deploy that balance sheet. But in holiday week, the people with authority are not at the desk. They are in Aspen. They are on boats. They are at dinner. They are offline. So who is left? The skeleton crew, junior traders, the people with 2 years of experience who drew the short straw and had to work while everyone else vanished. Put yourself in that position. You are 25 years old, sitting on a desk at a major bank. Your boss is somewhere warm. You have one instruction, and it is not complicated. Do not lose money. Keep the book flat. Do not create problems. Then silver spikes $2. Your screen turns into a fire alarm. Risk models start screaming. Value at risk jumps. Internal limits blink. Somebody from risk calls your line. What do? Do you heroically short more to stop the rally? No, you cannot. You do not have the authorization. You are not going to risk your career by taking a swing at a runaway market with your boss unavailable. So you do what scared traders always do. You cover, you reduce exposure, you buy back shorts to stop the bleeding. You choose the decision you can explain, because you would rather explain why you closed the trade than explain why you let a $50 million loss grow into a catastrophe. This is why holiday moves are violent. The adults are gone, the kids are scared, and scared traders buy to cover. Now add the next accelerant, the one most people never consider until it is too late. Options. We are approaching month end. Options expiration is looming, and there is a heavy concentration of call options at $70. That level matters not just because it is round, but because of positioning. Market makers sold those calls. They are short the calls. As price approaches that strike, they have to hedge, not because they want to, but because their models require it. Their hedging is mechanical. It does not care about Christmas. It does not care about headlines. It does not care about your feelings. It cares about math. As price gets closer to $70, delta rises. Gamma becomes aggressive. The hedge requirement increases. So the algorithms buy futures contracts to stay neutral. In a liquid market, they can do this quietly. In a thin market, their hedging becomes a loop. Buying pushes price higher. Higher price forces more hedging. More hedging means more buying. And because the order book is thin, each wave of buying moves price more than it should. This is how you get a flash move to the upside. Not because the world suddenly discovered a new use for silver overnight, but because the market structure is brittle and the hedging engine is pressing against empty air. If the loop engages near $70, you can jump multiple dollars before anyone can react. You are not climbing stairs, you are taking an elevator. And while all of this chaos is happening in the paper market, the physical market is entering its own kind of lockdown. Refineries and mints do not operate like websites. They shut down for the holidays. They run maintenance. They audit inventory. They clean equipment. They pause production. That means new supply slows or stops for a stretch. No new silver eagles rolling off machines. No fresh bars hitting the pipeline at the same speed. The physical flow tightens. But demand does not take vacation. The internet does not sleep. Retail buyers keep clicking. Dealers keep receiving orders. Industrial procurement still runs. Companies still need metal, so you get a collision. Steady demand meeting stalled supply. That drains existing inventory. Dealers start running thin. Restocking times extend. Backlogs grow. And the market starts to price not just what is happening today, but what will happen when everyone returns in January and realizes shelves are emptier than expected. This creates a front-run effect. People know January can bring delays, so they buy in December to avoid January pain. Demand gets pulled forward into the weakest liquidity window of the entire year. That is why premiums can stay elevated even as spot rises. In a normal market, spot up often means premiums soften. But when dealers know they cannot easily restock until mid-January, they keep premiums high as a brake. They are trying to slow the flow, and the brake is failing because the psychology has changed. This is the moment where the market stops feeling like a trade and starts feeling like a chase. Now circle back to the number that everything keeps orbiting. $70. It is not just a price. It is a public trigger. It is a psychological fortress. It is a structural landmine. It is the strike that option writers defend. It is where stop losses cluster. It is where narratives flip. Here is why. Round numbers repel price at first because humans sell there. But if price keeps returning, the repulsion turns into attraction. The magnet flips. If silver prints $70, even by a few cents, it triggers stop losses from shorts. Those stops are not thoughtful orders. They are market buys. They hit instantly. They add fuel to a market already low on supply. So the wall becomes the gasoline. This is why you see price bang against the door. It is not random. It is pressure building before release. And there is another psychological shift that happens when the first digit changes. A price in the 60s feels like expensive 50s. A price in the 70s feels like something bigger. It feels like the next chapter. It pulls in different buyers, momentum buyers, trend chasers, people who only enter when they see a breakout. That is reflexivity. Higher prices attract buyers. Buyers cause higher prices. The loop feeds itself, and the banks understand this. They have spent decades trying to prevent that kind of narrative shift. They do not want silver wearing a 7 handle because it changes the conversation from cheap metal to something is breaking. Now think about the holders, the people sitting on physical. When price rises, confidence rises, and confident holders do not sell. They hold tighter. The banks rely on weak hands. They need you to look at $69 and feel relief, like you can finally escape. They want you to dump into their buying so they can cover without launching price through the ceiling. But if holders are looking at $69 and thinking, I was right and I want more, then the supply of willing sellers shrinks. That is a seller strike, and a seller strike is poison for shorts. Paper supply can be created. Conviction cannot. Now add the industrial buyer, the procurement manager at a major manufacturer. They are watching the same screen. They see the same relentless uptrend. At $60, they were irritated. At $65, uncomfortable. At $70, terrified. Because at $70, budgets break, forecasts break. The CFO gets involved. They realize just in time inventory is a fantasy when the market is moving like this. And what do industrial buyers do when they fear higher prices? They do not buy for next month. They buy for next year. They front-load demand. They hoard inventory. They pull future consumption into the present. That creates a vertical spike. So you have a thin holiday market, a nervous skeleton crew, options hedging, physical supply slowing, public attention still muted, industrial demand ready to panic. Everything points to the same truth. The market is not calm. The market is fragile. And in a fragile market, a single number can act like a match, $70. If it breaks, the move stops being linear. It becomes exponential. And that is where we go next. So now we arrive at the edge, the point where everything converges into a single decision zone. Silver is trading near $69. The market has erased Friday's drop. The shorts are exposed. Liquidity is thin. And the calendar is working against anyone trying to regain control. This is where things stop being theoretical. Because $70 is not just a level on a chart. It is a boundary between two different regimes. Below $70, silver is treated as a trade. Above $70, it is treated as a problem. For decades, the financial system has trained itself to contain this market. First, the wall was $30, then it was $50. Now $70 stands as the final barricade. And here is what makes this level uniquely dangerous. There is no price memory above it. Look back at history. 1980 peaked near $50. 2011 peaked near $49. That means there is no generation of investors waiting at $75 to break even. There are no trapped sellers overhead. There is no natural supply waiting above. When an asset enters territory it has never occupied before, it is called blue sky. In blue sky, technical resistance disappears. Trend lines lose relevance. Retracements fail. Price does not move until it hits resistance. It moves until it finds fear. And fear only shows up when prices feel absurd. That is why blue sky moves can feel irrational. They overshoot. They surprise. They run further than anyone expects, because everyone is already in profit and nobody wants to be the first one out. Now consider what happens psychologically when the handle changes. The handle is the first digit of the price. When silver moved from $19 to $20, perception shifted. When it touched $50, the world noticed. Moving from the 60s into the 70s does something different. To the average investor, $60 feels like an expensive $50, but $70 feels like the gateway to $100. Anchors move, targets change. Instead of asking, should I sell? People start asking, how high can this go? That shift pulls in momentum traders, the crowd that only buys strength, the ones who wait for confirmation, not value. This is where reflexivity takes over. Higher prices attract buyers. Buyers drive higher prices. The loop feeds itself. And that loop is exactly what the banks fear most. Because once the narrative flips, control is lost. Now let's talk about what happens next, regardless of direction. There are only two levels that matter from here. The ceiling at $70, the floor at $67. Everything else is noise. If silver breaks $70 and holds it on a daily close, the move accelerates. Shorts capitulate. Hedging intensifies. Media wakes up. The market shifts gears. But if price fails and drops back below $67, that changes the character of the move. It suggests today's rally was a trap. It tells you sellers regained footing. That is why $67 matters. Old resistance often becomes new support. As long as price stays above that level, the trend remains intact. And right now, silver is well above it. Now comes the hardest part for anyone holding this market. Not buying, not selling, holding. It is easy to hold when you are losing money. You have no choice. It is incredibly difficult to hold when you are winning. The temptation to lock it in is overwhelming. The urge to be right instead of rich creeps in. This is where the banks try to exploit psychology. They know leveraged traders are greedy. They know margin amplifies emotion. That is why this moment is lethal for leverage. In a thin holiday market, price can swing $5 in an hour. If you are leveraged, a $5 move wipes you out. You get a margin call. Your position is closed at the worst possible moment. And then price reverses without you. You were right about direction, and you still lost everything. This is not an accident. Banks engineer shakeouts to hunt leverage. They push price just far enough to liquidate the gamblers, then let it run. That is why physical metal matters here. Physical silver has no leverage, no margin call, no counterparty risk. If price drops $10, you still own the same ounces. If price rises $10, nobody can force you out. Defense comes before offense. Now zoom out. Where are we in the larger cycle? Silver has broken a multi-year consolidation. It has cleared the psychological barriers at $30, $50, and $60. It has entered the recognition phase of a repricing event. This is not the mania phase. This is not the blow-off top. This is the stage where the world starts to realize that silver is not optional. It is essential. It is essential for energy, essential for technology, essential for infrastructure. The move to $69 is not pricing in the future. It is barely pricing in the present. It does not reflect upcoming demand from battery expansion, solar build-outs, or industrial reshoring. That demand is still coming. So do not let the height scare you. Yes, $69 feels high compared to $20, but compared to mining costs, supply deficits, and monetary expansion, it is still early. Here is the plan from here. Watch $70. That is the next domino. Respect volatility. Ignore intraday noise. Do not chase with leverage. Holiday trading is erratic. Price will whip around. Hold what cannot be liquidated out from under you. Because today told you everything you need to know. The banks tried to smash the market on Friday. They failed. They tried to scare holders out. They failed. On a quiet Monday before the holidays, silver surged nearly 3%. That is not a coincidence. That is a message. Control is slipping. The shorts are reacting, and the path of least resistance is still higher. You waited, you held, you stacked. Now the game changes. The Monday massacre was not the end. It was the opening signal. Now we watch what happens when the market tests the final wall, $70, and we see who blinks first. Thank you for your attention so far. Thank you very much, and don't forget to subscribe to our channel. See you in the next video.